Salam Sejahtera. Our group will be discuss about our assignment, which the difference between Takaful and conventional insurance and its implication for the Muslim market. My name is Eric bin Kamsa, and I will be the first presenter for our group. As you can see, this section provides a general introduction to the study, which examines the financial protection system designed to safeguard individuals, families, and business against unforeseen risks such as accident, death, illness, and property loss. Although both systems share a common objective of risk mitigation, their underlying principles that philosophical foundation differ significantly. In the Malaysian context, Takaful holds a distinctive position as it operates within the Islamic financial system and is structured in accordance with Sharia principle. This makes it a preferred alternative for Muslim consumers who seek financial protection that aligns not only with economic needs but also with religious obligation and ethical consideration. Accordingly, this study analyzed the issue from three key dimensions, namely structural differences, operational differences, and their implication on Muslim consumer acceptance and market behavior. Within the literature review, the discussion begins with the historical development of Takaful Malaysia. The emergence of Takaful is closely intertwined with the evolution of the Islamic financial system in the country, which was established to provide Sharia compliant financial alternative alongside conventional finance. Prior to the introduction of Takaful, conventional insurance functioned as the primary mechanism for risk protection in the financial market. However, among Muslim scholars and consumers, concerns were raised regarding the presence of elements such as riba, which is interest, gharar, which is uncertainty, and maisir, which is gambling, which are incompatible with Islamic jurisprudence. As a response to these concerns, Takaful was introduced as a cooperative risk-sharing mechanism grounded in the principle of mutual assistance, which is ta'awun, and voluntary contribution, which is tabarru. This development reflects not merely the introduction of the financial product, but a broader institutional effort by Malaysia to construct a comprehensive, integrated Islamic financial ecosystem. Moving forward to section 2.1.1 elaborates on the early development and regulatory foundation of Takaful in Malaysia, which marks the establishment phase of the industry. The formal introduction of Takaful can be traced to the establishment of Syarikat Takaful Malaysia Berhad in 1984, which served as the first licensed Takaful operator in the country, which operation commencing in the 1985. This milestone was further reinforced by the enactment of the Takaful Act 1984, which provides foundational legal framework governing the industry. In addition, Bank Negara Malaysia played a central regulatory and supervisory role in ensuring that Takaful operation were conducted in compliance with Sharia principles, while maintaining financial stability and operational integrity. Hence, the earlier development of Takaful in Malaysia was not a spontaneous market response, but rather a structured outcome of coordinated institutional planning, legal establishment, and Sharia governance reinforcement. 1.2 discusses the expansion of the Takaful industry, governance reforms, and overall market growth. Following its initial established phase, the Takaful industry gradually evolved from a relatively small and emerging sector into a more structured, competitive, and institutionally regulated industry. A significant milestone in this development was the introduction of the Islamic Financial Service Act 2013, IFSA 2013, which strengthened the regulatory framework by enhancing Sharia governance, risk management, and supervisory oversight of the Islamic financial institution, including Takaful operators. From a market perspective, the Takaful industry has demonstrated consistent positive growth reflected in the increasing volume of fund assets, contribution income, and diversity of protection product offered. Nevertheless, despite this encouraging expansion, the overall market penetration rate remains relatively moderate, indicating the need for continuous improvement in consumer education, product accessibility, affordability, and public awareness to further enhance participation, particularly among Muslim consumers.
Assalamualaikum Doctor. My name is Muhammad Izzuddin bin Saiful Izan and my matrix number is BG2311034. Next, I will explain about the difference between Takaful and conventional insurance in terms of structure and risk. For Takaful, it is based on the concept of mutual cooperation and risk sharing. There are three main contract structures, which is Wakalah, Mudharabah, and hybrid model. In the Wakalah model, the operator acts as a representative of the participant in managing the Takaful fund and receive a Wakalah fee for management service. In the Mudharabah model, participant as Rabbul Mal provide the capital while the operator act as Mudharib manage the investment. Profit are shared according to an agreed ratio while losses are borne by the participant unless negligence or misconduct occur. The hybrid model combines both Wakala and Mudharabah, where Wakala is used for fund management and Mudharabah is used for investment activities. This makes the system more flexible and efficient. In terms of risk, Takaful is based on the principle of risk sharing through the Tabarruk Fund. This fund is used to assist participants who suffer losses or claims. The operator only manages the fund and does not own the risk. This system emphasizes values such as trust, transparency, ethics, and mutual assistance. On the other hand, conventional insurance is based on exchange contract between the customer and the insurance company. The customer pays a premium and the insurer provides financial compensation in the event of covered risks such as death, accident, or property loss. In this system, the premium becomes the property of the insurance company and is used for claims, investment, and operational costs. In terms of risk, conventional insurance uses a risk transfer concept where the risk is fully transferred from the customer to the insurer after payment of the premium. But if no claim is made, the premium becomes the company's profit, making it a profit-oriented model. And from a Sharia perspective, conventional insurance is often associated with element of gharar, maisir, and riba due to its commercial exchange-based structure. Next, moving to 2.3 issues and challenges in Takaful. Overall, the challenges can be divided into five main areas: Sharia issues, legal and regulatory issues, operational issues, community awareness, and sustainability issues. First, for Sharia issues, Takaful must always ensure full compliance with Islamic principles. This includes ensuring that all products, investment, and operations follow Sharia requirement. However, challenges arise when new products such as micro takaful, wakaf-based or zakat-based takaful are introduced, as this require careful Sharia evaluation and approval. Next, legal and regulatory issue also play an important role. Although Malaysia already has strong regulations such as the Islamic Financial Service Act, there is still a need for clearer and more flexible guidelines, especially for new and emerging products like micro takaful, which serve low-income groups. Moving to operational issue, some takaful operators face difficulties such as inefficient system, lack of resources, and limited organization support. In addition, digital process like registration, contribution payments, and claim need to be more user-friendly to improve customer experience. Then, community awareness issues remain a major challenge. Many people still have limited understanding of how Takaful work, especially its principle of risk sharing and mutual assistance. This lack of awareness affect participation rates, even though Takaful is a Sharia compliant protection system. Finally, sustainability issues are becoming more important. This includes challenges in implementing value-based intermediation for Takaful VBIT, as well as managing risks related to climate change, particularly through parametric Takaful products such as flood and natural disaster coverage. This issue require better data, stronger risk management system, and improved capability within the industry. Thank you.
Moving on to our first finding, I will explain the structural differences between Takaful and conventional insurance in Malaysia. In Malaysia, both Takaful and conventional insurance provide financial protection. However, the way they are structured is different. First, conventional insurance is based on a risk transfer concept. This means the policyholders pay a premium to the insurance company. After that, the insurance company owns the premium fund and takes responsibility for the risk. Takaful is different. It is based on mutual help and risk sharing. Participants contribute money into a share fund called Tabarro. This fund belongs collectively to the participants, not fully to the Takaful operator. Second, the role of the company is different. In conventional insurance, the company acts as the insurer and risk bearer, but in Takaful, the operator only manages the fund. The operator may act as an agent under the Wakalah model or as a manager under other Sharia compliant models. Third, Takaful also has a different organizational structure. Some Takaful operators are fully independent, while others may share services with conventional insurance companies. This is important because Takaful must maintain clear Sharia governance. Overall, Takaful is not just insurance with a different name. It is a Sharia compliant system built on cooperation, shared responsibility, and mutual protection. Next, I will explain the differences in terms of operational between Takaful and conventional insurance. In conventional insurance, the process starts when the policyholder pays a premium to the insurance company. After the premium is paid, the money belongs to the insurer. This means the insurance company owns the premium fund and manages it as part of the company's assets. Next, the insurance company will carry out underwriting and risk assessment. This means the company checks the level of risk before issuing the insurance policy. After that, the company manages the premium fund, invests the money, arranges reinsurance, and handles claim assessment. If an insured event happens, for example, an accident or loss, the insurance company will pay the claim or benefit to the policyholder according to the policy terms. However, if no claim happens, the premium usually remains with the insurer. Any profit or loss from the operation mainly belongs to the insurance company or its shareholders. So, in simple words, conventional insurance is based on risk transfer. The policyholder transfers the risk to the insurance company, and the company takes the responsibility for the risk. Furthermore, I will explain how Takaful operates in Malaysia. Takaful works differently from conventional insurance. In Takaful, participants do not simply pay a premium to the company. Instead, they make a contribution based on tabarruk, which means donation or mutual assistance. This contribution goes into the participants' Takaful fund. The fund is owned collectively by the participants, not by the Takaful operator. The operator's role is to manage the fund as an agent or fund manager, depending on the Sharia contract used. From this fund, claims are paid to the affected participants. The fund is also used for Takaful costs, reserves, and Sharia-compliant investments. If there is a surplus, it may be shared with participants or retained in the fund. If there is a deficit, the operator may provide Qard Hasan, which is interest-free support to strengthen the fund. Takaful operation is also supported by studies in Malaysia. The findings show that Takaful and conventional insurance may perform almost the same in terms of premiums, but Takaful can perform better in investment income. Other findings also show efficiency differences between both systems. This is because Takaful follows a more conservative Sharia compliant investments approach, which can help reduce financial risk. Therefore, there are clear differences in both structure and operation between Takaful and conventional insurance. Based on our findings, Takaful appears to offer stronger performance in certain areas and is more suitable for the needs of the Muslim community because it operates according to Sharia principles.
Next, I will present the implication towards the Muslim market based on the differences between Takaful and conventional insurance, with a particular focus on Malaysia. First, let's look at the advantages of Takaful for Muslim consumers. One of the biggest advantages of Takaful is that it is fully Sharia compliant. Unlike conventional insurance, Takaful avoids prohibited elements such as riba, gara, and maise. Instead, it operates based on mutual cooperation or ta'mun and tabaruk, which means voluntary contribution. This means participants share risk collectively instead of transferring risk to an insurance company. As a result, Takaful promotes fairness, social responsibility, and risk sharing, which are values strongly encouraged in Islam. In addition, studies show that religious obligation is one of the main reasons Muslims choose Takaful. Consumers with higher awareness of Islamic finance are also more likely to prefer Takaful because it provides both financial protection and peace of mind by complying with Islamic principles. Next, let's discuss the challenge facing Takaful in Malaysia. Although Malaysia has one of the most developed Takaful industries in the world, there is still significant room for growth. Research shows that Takaful penetration in Malaysia is around 18%, which is much higher than countries like Pakistan, where the penetration rate is below 1%. This reflects Malaysia's strong regulatory support and well-developed Islamic financial ecosystem. However, several challenges remain. Firstly, Takaful operators generally have a smaller market size, making it difficult to achieve economies of scale compared to conventional insurers. Secondly, they incur higher operating costs because they must maintain Sharia governance, appoint Sharia advisory boards, and ensure continuous compliance with Islamic principles. Another important challenge is low financial literacy. Many consumers, especially those in lower income groups, still have limited understanding of how Takaful works and the benefit it offers. This reduces participation even though the products are available. Finally, let's look at why conventional insurance continues to dominate the Malaysian market. Despite Malaysia being a global leader in Islamic finance, conventional insurance continue to maintain a strong position. This is because conventional insurers have larger market share, wider distribution networks, and many years of operating experience, allowing them to achieve better cost efficiency. As a result, they are often able to offer more competitive prices, a wider variety of products, and greater convenience for consumers. Therefore, many Malaysian consumers make their decision based not only on Sharia compliance but also on affordability, accessibility, service quality, and coverage options. Overall, Takaful has a clear competitive advantage from a religious and ethical perspective. However, for Takaful to further strengthen its position in Malaysia, operators must continue improving operational efficiency, increasing public awareness, and offering more competitive products and services. By doing so, Takaful can better meet the evolving needs of Malaysian Muslim consumers.
In conclusion, Takaful and conventional insurance both play an important role in providing financial protection to the community. However, both are built on different foundation. Takaful emphasizes Sharia principle, mutual assistance, tabaru, and risk sharing, while conventional insurance is more based on commercial contracts and risk transfer. This difference has an important impact on the Muslim market as a Muslim consumer. Not only see the financial benefit, but also assess Sharia compliance and confident in the product. As such, Takaful has great potential to continue to grow in Malaysia, but Takaful operators need to increase consumer awareness, product innovations, quality of service, and price competitiveness so that Takaful becomes a stronger and more reliable hedge option. That's all from us. Thank you.